Hello, everybody, and welcome to the podcast. Today, you're going to hear how one goes from being a NASA engineer to being a full-time multifamily real estate investor and director of acquisition. So I'm very, very happy to have with me today, Chad Sutton. Chad, welcome to the show.
Hey, Jonathan, happy to be here. This has been a long time in the making, and yeah, let's make some magic here.
Absolutely. So let's just start this off by, giving the listeners, just to situate the conversation, the snapshot of where you are right now. So we'll hit your backstory later, but today's July 6th, 2023. What is it that you do at this moment in time in your life?
Yeah, so and it's funny you said July 6th because it just reminded me this is my birthday. I'm 1 year older today, so that's kind of funny.
Happy birthday.
So we're on my birthday, 35 years young. I feel like I've lived multiple lifetimes in 35 years and run businesses and all sorts of stuff. So very blessed to be where we are. I am the my title is director of acquisitions. It's really director of transactions and capital markets. I do all the things related to debt, equity structuring, fund structuring, and I head up our investment committee for, what assets we decide to acquire and dispose of and things of that sort. So it's really expanded. I probably need to update that title, but, who is Quattro Capital? We're all over the place. So, you've probably heard the term Quattro at some point if you're listening to the show right now. We are heavily invested in the Southeast and Texas and a little bit of the Midwest. We're primarily a syndication company catering towards the accredited and non-accredited investor database. We do work with some qualified clients and qualified purchasers as well, but we are people for the people. So we spend a lot of time, how do we do good while we're doing well? And how do we help others, really find a way to generate a good return in the real estate space by getting access to these larger investments. So, we specialize in multifamily value add. We've done everything from, Class D war zone type stuff to the luxury stuff and everything in between. So we made a lot of our, I'll say track record doing C class to B class repositions in the, we'll call it the prior cycle at this point. I am a firm believer we're in a cycle right now. The last couple of years we've been focusing on, just acquiring good, solid B class buildings with good bones, things that are got a couple $100 of rental movement and for some kind of a beautification project, so we've done enough, difficult projects where we've had to deal with a tough resident base and the impacts of COVID on that and things of that sort. So we're not really about that anymore, but that's our primary focus. And, we were just talking about this today, Jonathan. We are moving, instead of being total owner operator mode, we're moving into more of actually a capital group. So the name Quattro Capital may be more appropriate going forward. We are positioning ourselves to do about 25% of our equity that we raise and deploy into our own deals in the multifamily B class value add space where we're hyper niched. But, we also want to give our investors and ourselves, exposure to some of the great operators in the private equity space, acquiring HVAC companies, for example, and turning mom and pops into organizations. Think about car wash franchise opportunities, low basis, high cash flow type stuff. Hotel conversions are pretty hot if you know how to do them in the right location. So what we know is we're good at what we're good at, and rather than develop the expertise, we're very good at positioning equity, and so we're going to start moving into that world as well. So if that's you, love to reach out and maybe hear what you're good at and how we might be able to help each other.
So you're kind of shifting your focus away from strictly multifamily into more of a diversified, kind of offering, I guess, for your investors. So, what is behind that?
Yeah, so I think it's, there's a lot of really good sectors out there. I still stand behind the fact that multifamily is one of the best, if not the best, equity multiple you're going to get on a net operating income. I mean, right now at a 5 cap, it's even at a decompressed 5 cap, it's about a 20x multiple, whereas if you do something in private equity, it's probably 10x. Now, the reason that I'm looking elsewhere, it's interesting that, we chose to do a value add program on, a brick and mortar that has a bunch of individual residents in it. So value add is not just applicable to multifamily, it's applicable to any business, right? And there's a lot of other sectors out there that are, so I love core industries. core industries, things that, whether the economy is up or down, they're necessary. So things like, when I mentioned private equity, things like an HVAC company or an electrician company or something of that sort that is a staple. You're always going to have it, and people will pay what it requires to get that service, because they're not going to go through summer without HVAC, right? So it's but the beauty of that example, there are a tremendous amount of mom and pop owned and operated companies like that are staple services. And oh my gosh, if you have the right experts who know how to, come in and put a templated model together and actually aggregate some of these things, you can wind up with a regional HVAC company that was built out of, lower, well, not lower quality, just lower focus mom and pop operators. And all of a sudden you have something that is sellable to, some sort of a investor hedge fund or something like that. So the model that I really love is buy a bunch of little things that are mom and pop operated or less efficiently operated, put them together and sell them to a big guy. That's what we've done in multifamily a lot. We were buying, I'll say a lot of our success, Jonathan, we were buying sub 100 unit buildings for a long time. And I'd buy 7 or 8 of them in an area, get them operating and humming nicely, and sell them to a well-to-do investor out of California or something like that. So it's, if you can, I think Sam Zell is probably the best person that I've seen at this. You don't always have to look at the shiny object everybody wants. If you can find little pieces that if you put them together, 1 + 1 = 5 or something like that, you can really generate a great return. So back to why are we doing this? It's about getting exposure to other essential areas of the market, right? And so when I say things like, the private equity HVAC company, the multifamily stuff, I do view self-storage as a necessity. It ebbs and flows differently as multifamily does, but it's a necessity. People, especially when they're in trouble, it's kind of a counteraction to the economy going up. People need to store their stuff when they have to downsize, So it's there's a lot of other interesting places that I think if you get exposure to can be fantastic, but you can't be an expert in everything unless you want to bring all that expertise in-house. I do not,
So where do you plan on getting the expertise to do this? Oh, I'm sorry. You actually told me that. I just messed that up, because you're looking to actually become a fund that's going to allocate into those areas. Is that correct? So that's where you're going,
that's right. And
yeah.
so it's very interesting. If you want to find the best in the business, you just got to get in the right rooms. And so I'm actually wearing a shirt right now of one of the latest groups we've joined. It's a group called Fund Launch. And this is it's instead of being like a multifamily mastermind or a hotel mastermind or something, it's just about funds. Anyone who is running a fund around the country is eligible to join. And it's just a massive group nationwide. Actually, it's global. There's international funds too, of fund managers. And so it's like, there might be foreign exchange funds, there might be hotel conversion funds, there might be car wash funds. But the point is, we're all coming together on a commonality of how do you run a fund better, but by definition there, you get exposure to, the movers and shakers in all sorts of different industries. And so it takes time. You're not just going to find one and say, okay, I'm going to put money right there. It takes relationship building, just like you do when you're raising capital, right? You're basically saying, okay, now I'm not just raising capital, I'm raising talent, and if you, like, in my opinion, the true wealth and power in this country comes from A, controlling the capital, and B, knowing where to put it to get a return, right? The operators are a dime a dozen. I mean, I'm insulting myself just like I'm insulting anyone who's an operator by saying that. We are a dime a dozen. Any guy can walk off the street, and call himself an operator and probably find some success if the market's pretty good. But not everybody can aggregate capital, and not everybody can hold the trust of that capital and be the person who knows where to put that money to balance risk and return, right? And so I think, in my opinion, that's kind of the golden ticket. If you yourself are able to A, raise capital, and B, know where to put it to balance the investor's needs, wants, and risk tolerance, you're the guy, and so, yeah, you got to build that Rolodex.
And how do you plan on doing this? I mean, you're planning on raising a fund of your own that'll then invest into other funds, or you're looking to raise capital on a kind of deal by deal basis to put into these operators that you find, that you identify as being experts and the best in the business?
Yeah, that's a great question. And, I think the syndication model, which is, talking jargon, the syndication model is really the deal by deal basis. And I think it works really well if you're the operator. I don't love the syndication model when you're working with other operators. And the reason is, even when you're the operator, you don't get them all right. Not every one of our projects has gone perfectly according to plan and been a home run. Some have been, single base hits, and some have been home runs, and some have been doubles, So I think even when you're the one in control, you have that variability. And so I think, raising it as more of not a blind fund, but maybe you launch with a project and buy 4 more like it or something like that, or place money into 4 more like it. If you run it out of the fund model, you at least have the benefit of, okay, well, maybe these 3 operators knock it out of the park and this one only hit a single. Well, everyone still did good, so they're okay, right? Whereas if you had 4 different funds in that situation and you picked a mediocre operator, well, you won't work with them again, but at least you don't tarnish your reputation that way. So, I think the fund model is a much better fit for aggregators. It has some extra disclosures and things of that sort. So you're going to need the appropriate legal team and accounting team and all that kind of stuff, but no different than a syndication. But in that space, I think it's a better way to kind of, go ahead and aggregate the money and be able to stroke a couple of checks into different deals and monitor progress that way. And then you get a good blended average,
So I've, noticed a lot of people that I know in the business who, and other acquaintances that have been raising funds recently. And it's kind of an interesting phenomenon to me because, sort of 10 years ago, maybe not quite that long, 8 years ago, after I had, built my own portfolio and kind of demonstrated that I could do this, I decided to raise a fund. And for me, the logic seemed pretty straightforward. I mean, look, any one deal may be great or may just go wrong and you don't really know, and oftentimes it's the deals that you think are not going to be that great that are off the charts, and the ones you think are slam dunks that just sort of limp along, and you never really can tell with perfect accuracy. So diversification is really the name of the game. When I went out to raise a fund, I had people saying to me, no, we just want to look at deals. We'll diversify on our own. We just want to look at deals, right? And I think it was because during the financial crisis, a lot of people got burned with funds where they put money into blind pool funds, and then with managers who didn't really know what they're doing. Now I see, though, kind of the trend has come back in the other direction, where people are kind of recognizing the importance of diversification even within an asset class. And I'm just wondering if you're seeing the same thing, if maybe that's partly what's behind, what you're doing. So just speak to that a bit.
That's a great question. I think it really comes down to the psyche of your investors. And this is not a one size fits all answer. It's going to depend, where you're sourcing people from and what their experiences have been. But I think that the private offering world has become a lot more popular in the last 10 years than it was before, and I know we've gone through a couple of cycles of this because, back before the savings and loan crisis, there was a similar popularity where partnerships became very, very, very wildly known. And then, some tax changes happened and they didn't happen for a while. So it's all dependent on the tax law and things that are going on in the world. But anyway, I digress. I think when it comes down to the investor psyche, a lot of people who are exposed to the type of offerings we're talking about, who listen to podcasts like this and, are in tune with the world, they've probably done 3 or 4 or 5 syndications, and they've had one that went, horrible, and maybe 4 that went great. And so I think it's easy to kind of bridge that gap and say, look, that, diversification, I hate the word, I really do, because it's like, you have a CFP, who will tell you to diversify, and they're talking about spreading everything around all the baskets. So you kind of have a 0-sum game, and if one's down, the other's up. And it's, I don't like that, because then you're just basically exposed to all wins and you get a net zero, or maybe a net growth. But if you're talking about diversifying within the same asset class you want to be in, but across different projects, I really like that and I'll give you an example, Jonathan. I mean, we have owned properties in Atlanta, Georgia, and that is a godforsaken town. I will never go back to it. It's a horrible place to operate, and there's this pressure after pressure, but the economics are all there. Like, the rent growth is there, the population growth is there, the job growth is there, the wage growth is there. So on paper, you should be making a ton of money. But what's slid very drastically since 2020 is the number of police officers in the city down, like 400%. The number, the ability to get an eviction if someone doesn't pay rent. You can get them evicted, you just can't get them out of the unit for 18 months. A set out and an eviction are two very different things, in Atlanta, Georgia. So I say all these things to say that, on paper, all these things look great. No operator ever shows you a declining pro forma where you're going to, things aren't going to go well, right? It's always up, double your money in 5 years, all the stuff. So, but the reality is, some of them are going to fail, and some of them, and failure does not necessarily mean catastrophic failure. Hopefully not, but it means they may not hit the return projections they're talking about. And so it's much easier to say, look, it's highly likely that if I go buy 5 properties, 4 out of 5 are going to do great, and one's going to be mediocre at best, And I think that it's a great, just selling point of why a fund is a great idea. But what I'll tell you is people get themselves in trouble, Jonathan, by over generalizing their fund, right? So like if you're Blackstone, you can go say, hey, I'm gonna open a real estate fund for crash projects, and they might have the ability to go buy single family warehouses. I mean, they've got the resources and ability to do that. Fine, But for us, regular Joes who, don't have Blackstone behind us, you really need to focus on like, okay, if you're going to open a fund for, B-class multifamily projects in this area of the country, that's about as specific as you need to be. Because while the person may choose, I want to diversify this much of my portfolio into multifamily of this quality, then they can go say, okay, now that fund can go buy 5 or 10 projects. But if you say, I'm going to start a fund and it's going to be able to buy anywhere in the US and it's going to be any commercial real estate asset, you're not going to sell those positions. And the reason is that person he may want to be in multifamily. He may want to be even in self-storage. He may not want to be in office buildings, right? And so you kind of have to meet the market on the specificity of the fund. And then I think it's a much easier sell to say, okay, this is the same as doing a one-off syndication, except now you get the benefit of 5 properties of this type. And it's all, and pro tip, if you can launch your fund with a project and say, look, I'm going to go buy this project and 4 more just like this, it's much easier to touch and feel the asset. You know what I'm saying?
I mean, I think from a sales and marketing perspective, it's much easier for buyers in this case, who are investors in the fund, to kind of get their head around something that's a specific niche as opposed to everything. Sort of I have this conversation oftentimes with my students in a slightly different context where they're afraid that, I always tell them, start off, if you're, people are always asking me, how do I find investors? And I say, start off with the people who are like you. So if you're a doctor, start off with doctors. If you're a lawyer, start off with lawyers. If you're an engineer, start off with engineers, right? And people, they're always like, yeah, but aren't I going to miss out on all the rest of the world? And it's like, no, you're not. First of all, you can't have the whole world, but if you aim it at the whole world, you get nobody. If you say, I am the guy for engineers, then the engineers they're going to get it. They're going to be attracted to you. And that's how you start building a list. And obviously they'll refer other people in later who are not engineers, so you don't have to worry about it. It sounds to be the same kind of thing as with you're talking about with a fund, where if it's very specific and people know what it is that they're buying, they're more likely to buy it than if you just say, hey, it's real estate, or it's all real estate in Georgia, or whatever. The more specific you can be, the more they get it.
Yeah. And Jonathan, let's unpack that a little bit, because what you just said there is brilliant, right? When you're raising money, you can't just get on there and talk to everybody. So let's take a podcast, for example. If Jonathan got on here and one day he talks about cars, the next day he talks about airplanes, the third day he talks about real estate, and the fourth day he talks about going to church, like, who is his audience? He has no flipping idea. And so like, if you do that, if I'm interested in airplanes, you lost me after the 3rd episode. If I'm interested in church, I never got interested because 3 episodes were totally irrelevant. And so it's the same thing. You have to build status alignment and commonality with those who are going to invest with you. And the best way to do that as you're honing your skill is, if you're a medical professional, speak to medical professionals. You have a lot of the same problems and things you can empathize with that they do. If you're an engineer, do that. If you're a teacher, do that, but don't try to be don't try to be, I'm trying to think of an example. Don't try to be an engineer and go talk to a group of surgeons. You might be able to pull that off, but they're like, okay, well, he doesn't know how to talk like I do, And so it's harder to build that confidence. Now, when you have a track record and like, look, and like, I can talk to you now because I've done this 17 times and here's my rap sheet. Oh, okay. He knows what he's doing. Cool.
Yeah,
But
that's right. Once you're the expert, then it's a different story. But when you're starting out, right,
right.
and I don't mean to make this a discussion about like how you start raising capital, but just to close it out, what I always tell people is, people always come in and they're like, they have imposter syndrome. Why is anybody going to listen to me? I don't know. I don't have a track record, don't have whatever. And so that's not, the issue is really not that. The issue is whether people trust you or not. And if you're the same thing that they are, you already have status with them because you're one of them, right? So if you go talk to doctors, they're already you have credibility with them because you've already been through the same hard, effort that it took them to become a doctor. You've done that. So they trust you as one of them. And then they're willing to listen to you talk about real estate or what have you. But if like with your example, if you're an engineer and you don't have any track record and you're coming into a bunch of doctors and you're like, hey, I'm going to tell you guys about real estate, they might listen, but there's gonna a lot more credibility issues to overcome. So always start with the people that are like you because they already trust you because you're one of them. You already have authority with those people.
Yeah, exactly. And then expand your audience from there, but to bring it back to the fund model, I think, and you kind of mentioned why would, somebody might want to diversify themselves. I think that's where you leave it, is you really want to be specific enough that you're not trying to explain to them why an office building is not a dangerous thing while you're trying to tell them you're buying a multifamily building. Like you can be too broad. And look, if you remember nothing else that I say with anybody, confusion of the brain says no, period.
Exactly.
The end,
yep. Yeah, precisely. That's kind of what I was getting at with this. But so I do want to talk a little bit about, since I led off the show with you having gone from engineering to being, a real estate investor, I'd love to hear, how it is that you got into real estate in the first place.
Yeah, that's an interesting story. I'll try not to belabor it too long, but I'm a third generation real estate investor, and the second generation of my family are 2 of the 5 partners in Quattro. So, 3 of us are blood related. And the first generation was my grandparents, their parents. So there's a lot of kind of family officeness that goes to it, if you will. Just hold just a second. I got someone at the door. I think it's my wife, and the dog's going nuts. Let me do that real quick.
Sure.
Okay, we're back. We can cut back in.
All right. So you were saying that it's a family office of sorts, how you got started. Yep.
Right. So basically, I went the route of, corporate climb ladder, be awesome type person. I was great at playing with erector sets and Legos as a kid, and the world told me I should be an engineer, and I listened, and I was a damn good engineer for a long time. So, I went to school, did all that stuff, went to work for NASA for a time before the space shuttle stopped flying. So I date myself a little bit. Did some work there, and that was awesome, but then there was no future there when the space program had an uncertain future. So I went to the private sector, made a lot more money, had some interesting work in aviation. So I worked for General Electric for a long time. So I kind of, progressed through that career, Jonathan. And all along the way, I was, working increasingly harder and making incrementally more money. And I get a couple of promotions here and there. And, you jump salary bands and things of that sort. I was actually with the company when, you remember when the GE stock price went from like $50 to $5 or whatever it was. I was with the company there and got, the benefit of flying around the world. And when I got hired as an internal consultant, because I knew how to manufacture and design things, but I also had some business acumen. It was like, hey, go fix the P&L. Like, we got to figure out how to, get variable cost productivity down, which is like, how do we make things for cheaper on per unit? And so I got a lot of business savvy out of that, got a lot of international experience and negotiation and all that kind of stuff. That led to an executive role, which was ultimately my demise my own demise in the corporate America world. And so what happened is, I became a global purchasing manager. I owned about $1 billion in spend in heavy electrical components for wind turbines. Okay. My job was to negotiate with my suppliers, who are mostly privately owned mom and pop companies. Well, I guess you're not mom and pop if you're supplying GE, but it was a much smaller company than GE, right? And my job was to beat price out of them and take everything away. And I was good at it. It was a very immoral job, Jonathan. So I had an internal struggle, and along the way, I had designed some great technologies. I'd made a lot of money for the company. I'd saved a lot of money for the company. So I had these bells going off in my head saying, I have literally generated like multiple $1 billion in revenue for a company, and I make $1.50 a year. That's like, there's this little imbalance there. Started listening to a guy named Earl Nightingale, this really old mindset guy. He's on YouTube if you want to check it out. He's definitely dead now, but this is like old, 8-track tape stuff. And, one of the things that stuck with me was your rewards in life will be commensurate with the degree of difficulty of what you do and how hard it is to replace you. And that resonated with me. It's like, okay, even at what I'm doing now, if I left the company tomorrow, they'll have another Chad tomorrow, and probably a better Chad, so it kind of humbles you really quickly. But then I start, realizing, okay, my family's in real estate. Around that time, my grandfather passes away, major player in my life, major influence, big, boisterous Texas man. You couldn't help but laugh when you're around the guy. But after he passes away, we start getting involved in the family real estate business because, grandma wants to retire right off in the sunset and realizes what's important in life and all that. And so the second generation takes over, and I try to replicate it in Tennessee. And I realized, we owned a bunch of single family houses. So it was an empire of single family rentals, which is great if you have at least 50 of them. But if when you're, I think at the time it was like 74, 75 houses. But as I was trying to replicate this in Tennessee, it just didn't make any sense. It's like this, the rent ratios don't work. It's like, it's more of a, there's two income approach. There's two approaches to valuing property. There's comps and there's, income. And single family houses typically are not valued based on the income approach. They're valued based on what your homeowner will pay for them. Well, that was way out of whack with rent. So that didn't make any sense. So we start researching, Jonathan. We're like, okay, where are we going to how are we going to grow this thing? And so we start selling off some of the older properties we had. We start putting money into the good ones, and we could probably half the portfolio and like 3x the value within 18 months. And so my business partner Kim was like, "There's something to this, we got to do this again on a bigger scale." So how do we get into where we are today? We start looking at how to get better economies of scale. And after looking at, we spent a ton of money going to courses provided by universities to, everything to boot camps and books and everything in between. The number one generator of wealth in this country is real estate, by the way. All the common denominators, real estate is a part of it. Going back to the King of England days, even, it's like land. Land is what you own for wealth. And so all the research turns into, okay, we have a global and definitely a national housing shortage, and it's going to be that way for a very long time just because of the aftermath of the great financial crisis, right, in 2008. So like many did, we started getting into apartment buildings and doing well with them. And then shortly after that, people are like, you're doing pretty well here. Can we be part of that? I'm like, I don't know. Let's figure that out. Turns out there's something called the SEC, not the Southeastern Conference, but the Securities and Exchange Commission that you have to, follow some rules with. Y'all know about that SEC. A lot scarier than the Southeastern Conference. But anyway, we learned how to raise money, and the rest is history. Once you start pooling money together and using more than just your own, your ability to get velocity of money and get bigger, better economies of scale, it just all scales from there, and all your profits get more zeros, right? Your risk and responsibility is also there too. But that's how we got into it, and I'll see if you have any questions, but it's kind of a longer story, if you will.
Yeah, well, thank you for that. I mean, it did make me kind of think of a question that takes us back to where we started almost, which is, so in terms of now shifting gears and looking to do a fund that's a broader base, let's say, is your plan to continue to do the multifamily deals yourself and go into the other vectors as an allocator, or do you intend to also allocate to other multifamily deals? So,
I think both, right? And so I laid out a little bit of a ratio. I view, I guess I view our business in quarters, and maybe the name Quattro has me stuck there. I don't know. There's four, right? But we have 4 pillars and all that kind of stuff. So I envision a quarter of our business being Quattro for Quattro deals, right? Things that we will buy, operate. Eventually we're not going to buy as many as we have. We'll do like 1 in, 1 out, just maintain that quorum. And then the other 3/4, the other 75%, I think would be capital allocation. Now that might be to other multifamily operators in maybe markets we're not in, or maybe a slight different twist. For example, a hotel conversion in operation as a multifamily, that could be another vector. I think I'd probably prioritize expansions into some other segments that we don't have expertise in, just to kind of blend exposure a little bit. But I do stand by what I mentioned of core industries. Like I don't want to go invest in a tech company. I don't want to go invest in, which may become a core industry, but I'm not really all about the make 10 investments and one will do well. I'm more about the make 10 investments and they all do well and one does mediocre. So that means I'm not really going to be generating those 100x or 1000x returns that you get out of some of the venture capital space. But I do like the private equity space and core business, and I'm very, very pro of unit-based real estate, and that honestly even includes the multi-tenant industrial. I don't like big square footage stuff. I don't like one tenant, but I do like the new thing there where it's like you can have 15 tenants in one industrial building, and you can,
the flex industrial.
Yeah,
stuff,
flex
right?
industrial, exactly. So hope that answered your question, but
yeah, no, absolutely. And I did want to sort of touch on one more thing before we go, because this conversation time has really flown by on this podcast, I have to say. But so you mentioned before we started recording that one of the things that you've had to deal with and over the years, and I think a lot of us have, is lender drama. And I wanted to hear more about what you meant by lender drama, how you've overcome it. And sort of, I know you have some plans in that regard as well. So I'd love to hear about that.
Yeah. Every year we've been in this business, every single one, there's been some form of what we've come to call lender drama. And it is, in 2019, Fannie Mae I'm just throwing in some examples from recent memory. 2019, Fannie Mae ran out of money, and then some closings had challenges. In 2020, we all know what happened with COVID. People just dropped deals mid cycle, and so you might have been chugging right along, going on your merry little way, and then lenders just stopped lending. 2021, and 2022, we had different types of turmoil with rate movement and secondary market loans not trading well. So it's like, and now in 2023, we've moved rates faster than we have since 1970 or 1970s and 80s. And so what we're experiencing now is, some debt funds, bridge lenders, even if you're compliant with your loan, they're being very slow to fund because they're protecting their balance sheet. So if you're trying to draw construction dollars, you might be doing just fine on your project, but their balance sheet is not doing okay. They may have failing loans. They may be upside down from valuation versus, loans perspective. Even if you have a rate cap on a floating rate loan, they're still looking at the total index, and you're probably blowing that covenant, whether you can help it or not. And so it's like, whereas lenders used to fund in 2 to 4 weeks, it might be taking 2 to 4 months at best. And so you're experiencing cash problems, right? Because if you're having to front 2 to 4 months worth of, construction, you only planned on 1 or 2 worst case, you could be out a couple $1 million and be in a cash problem real quick. So, what I say when I say lender drama is I'm tired of lenders holding the bag and having too much control. Right now, I still love, and you will never be able to beat, in my opinion, government sponsored money or things like Fannie Mae, Freddie Mac, Ginnie Mae, those loans. I don't like highly leveraging things. I never have. So I think once we stabilize assets, we'll probably still go to 50 or 60% Fannie, Freddie, Ginnie, just to have some good long-term money in place. That's assumable and all that kind of stuff. But I'm personally done with debt funds. I'm done with local banks. I'm done with people who are scared of their shadow and get in the way of my business plan. So what we're going to do, as I mentioned, we're very good at attracting capital. And, as we attract some of those qualified purchaser, qualified clients, so above accredited investor and beyond, like $2 to $10 million type folk, they have a very different mission. They're not looking to necessarily grow as fast as you or I are. They're much more in the how do I keep what I have mindset, and so like to them and an attractive investment of, hey, I'm going to be first to get paid on this asset, first to get out of this asset. So, we're going to start putting together, and we're actually piloting one right now that we can just add zeros to and make it bigger, but we're going to do our own debt funds. And, there's some challenges we'll talk about with that, but, I want to control the whole capital stack. I'm tired of having someone else have me by the shirt collar and be able to affect, how fast we can execute on a plan. So we will do our own debt going forward, fund our own construction going forward, maybe even do our own pref equity. We'll see how the different properties call for different capital stacks, but having control of all the pieces, I think will really de-risk everything. And, people have heard me say this way too many times, Jonathan, you only get in trouble in real estate if you run out of two things. It all boils down to time or money. Right. As long as you don't run out of those two things, time heals all in real estate, and so that, and as long as you don't bleed out, by having something that's causing you negative cash flow for too long or something like that, you will be fine. So having control of that, we believe will give us security of those two things. And then, obviously the ability to take out to a low leverage, just cruise control type of Fannie Freddie Ginnie loan, those are pretty standard to maintain, Yeah,
I mean, I'm very interested in this actually, because I've experienced some lender drama myself, especially in this environment, and being able to control be your own lender is really attractive. And especially for certain asset classes, unlike multifamily, where you don't have, the government backed loans to turn to, where you're kind of really only forced to deal with local banks or other sources. And they can, right now, it's a good example, just been dealing with, I'm used to getting a term sheet in a week, took me 10 weeks to get a term sheet, now it's like in underwriting, for 3 weeks, and it's interminable. And probably because they're dealing with some of the issues that, you mentioned, where it's their own balance sheets. That's the problem, not my deal. But it would be great to be like out from under having to deal with that kind of stuff.
And it comes with, some challenges too, right? I mean, so like, if you're going to do this, you got to have a way to stay in tune with the market, because what you don't want to do is buy an asset, put your own loan on it and realize, oh shoot, values, are dropping 25% or something like that. So you have to make sure you kind of know what the lenders are doing. So I think as a good practice, you probably still want to go out and quote lenders and see where lenders are leveraging things before you make your own loan on your property, just to make sure you don't get upside down in the loan. But one of the biggest pushbacks I can see from investors is, well, wait a minute, you control the equity and the debt, so that's a conflict of interest, right? How are you going to make sure that I get paid first? And so what probably would happen, it's very simple to keep all the covenants and all that kind of stuff out of the way to where you have control of that. But if it gets into a default situation, my recommendation would be, set up an independent board, and they can be your accountant, your attorney, whatever else, but people who like have or it could even be a third party entirely who has experience. But if it got to where you're in a default situation, there would be like an independent manager who only has authority to say, if these thresholds are crossed, put it in default, foreclose, and that's kind of how you make sure that the integrity of the lender borrower relationship is still there. So you still got to pay your debts. I mean, folks, you can't do this and just not pay the loan that you lent yourself, but at least you don't have to deal with things like construction lenders not funding, or, excessive requests for documentation, or, oh, I'm going to stop letting you hold the cash flow because you just dropped below 1-to-5 coverage ratio for 3 weeks. It's like control your own destiny.
Yeah. Or net worth requirements that have nothing to do with the deal itself and things like that,
Exactly.
Yeah, exactly. Well, so we're kind of running out of time, but last question I had for you was, you mentioned that you've been very good at attracting capital, and I just wanted to ask about that. So what is your kind of, I mean, I hate the word secret, but what is your methodology for attracting capital?
Yeah, it's no secret, folks. And I think, check out Quattro Capital and just look at all the content we've got out there. We're not educators, we don't have a program or anything like that, but we are in a lot of different places. And what people have commonly said about us is you guys are different. You guys generally care about people. It's not just about dollars and cents. It's about doing good in the world and taking care of the people who have dinner around the dinner table with their families at your properties and things of that sort. So I could go into a lot of examples. We've done a ton of podcasts going through them, but I think the point is just be different, relate to people. Don't act like this institutional corporate thing, where your investors are just a number. Be people with them, relate to them. When they all have my cell phone number. If they need me, they call me and I answer. And so like we have a personal relationship, however that's possible, with several thousand people that we've talked to. One of our 5 partners has talked multiple times to every single investor we have, and I think that's very important. Is people just want to know. I think we're in a society where the consumer doesn't want to be marketed to until they're ready to buy, and they're looking for products and services they can trust the people behind it. And, I think a lot of people have been burned with big corporate institutional things of all sorts, like Steve Jobs never took my call when I had Apple stock, for example. And they've done fine, but if they feel a part of the deal, they feel a connection to it, they feel a connection to you, you're much more likely to attract people in. And then it's their idea to invest with you. You're never asking people for money. People are coming to you because they believe in you and the person that you are and the good you're going to do in the world, and how you're going to take care of the 2,000 hours of work they put in last year to earn that money, So it's more about the person, right? And I wouldn't say we have the best marketing tactics or anything like that. Our stuff is pretty. We have a great team, but we're not like the folks out there who are in your inbox every single day. It's just not us,
So it's all about the relationship.
Yes.
Well, on that note, if you would like to establish a relationship with Chad and the rest of Quattro, Chad, what would be the best way for people to get in touch with you?
Yeah, folks, the best way, type in chadsutton.info. That's CHADSUTTON.info. That will take you to a kind of a digital business card where you can find Quattro Capital. You can find the Real Estate Runway podcast. You can find all sorts of goodies in there about, who we are and how to connect with us. And actually, I think my cell phone number is in there as well. So you can just, we give that out freely. So yeah, love to connect with you. Love to have a conversation, even if it's just to say hi and see how we can help each other.
Well, Chad, I really appreciate the time that you took to be on the podcast today. I'm really happy that we had a chance to meet each other and looking forward to talking to you again soon.
Yeah, Jonathan, I really appreciate it and hope you have a wonderful day.